If you needed $4 million next month, maybe it's a chance to invest in a business at the right time, but you got to move quick to make it happen. Where would that come from? You got $4 million sitting in cash doing nothing? I hope not. You going to liquidate investments and generate a big tax bill? The IRS hopes so. Have you ever looked at your balance sheet the way a private bank would? Because if you haven't, there's a whole set of specialized lending tools available to families like yours. And that's exactly what we're going to cover today. We're going to walk through 9 specialized lending strategies that ultra-high net worth families use to access capital without selling, without triggering taxes, and without disrupting a portfolio that's compounding on their behalf. We'll skip over the basic ones you've probably heard of, like home equity lines of credit and margin loans, and get straight to the strategies that a lot of people have never heard of. For each one, I'm going to tell you a client story that shows you exactly how this works and who it's built for. I'm Jake Hughes, partner and private wealth advisor here at Blueprint Financial Group. As you know, our focus at Blueprint is working with families facing significant liquidity events, like business owners, executives with equity comp, and people with big concentrated stock positions. The strategies we're covering today come directly from that work. Let's get into it. There's 3 questions we ask that tell us which one best fits the situation. Number 1, what's the collateral? Is it an investment portfolio? Is it real estate? Some other hard asset? Is it a business? Or maybe there's no collateral. Number 2, what's the timeline? Is it a short-term bridge? Or is this going to be a long-term facility we keep in place? Number 3, what's the risk tolerance? Some tools carry margin risk. Others are non-recourse. The distinctions matter. Keep these in mind. They're the lens for everything that follows. Securities-backed lending. A tech executive came to us with a concentrated equity portfolio and an opportunity to invest in a private company alongside someone he's known for years. The deal had a short window. Selling the position or the portfolio to fund the deal would have triggered a massive capital gains tax. Instead, we set up a pledged asset line against his portfolio. He drew the capital he needed. The position stayed intact and kept growing, and he repaid the line 18 months later when the business started to generate cash flow. He made the investment, avoided the tax bill, and never had to sell a single share. One note on this: if the portfolio that we're lending against drops in value significantly, the lender could issue a maintenance call and require additional capital. Know your trigger thresholds before you draw. Specialized jumbo mortgage paired with securities-backed lending. A founder post-exit wanted a $9 million lake house. Writing a $9 million check would have meant liquidating a significant portion of a recently deployed portfolio. It would have triggered gains and pulled capital from investments that were compounding at a strong rate. Instead, he worked with a lender to structure a specialized jumbo mortgage with his investment portfolio pledged as additional collateral. This got him preferred pricing on the loan, and he was able to put $0 down out of cash. The portfolio stayed fully invested. The appreciation on the portfolio in the following months far exceeded the interest cost on the loan. One note here: now we're managing 2 things at once, a jumbo mortgage and a securities-backed loan. That can get tough, and we need to be strategic and organized. Specialized asset financing and lending, aircraft and collectibles. A manufacturing business owner was considering an aircraft purchase. The sticker price was $4.2 million. After structuring a specialized aviation loan and layering in first-year bonus depreciation on the documented business use portion of the plane, his net out-of-pocket expense in year 1 after the tax benefit was significantly lower than $4.2 million. We helped to coordinate the financing, the depreciation analysis, and the documentation with a specialized lender and his personal tax counsel. The plane was effectively partially subsidized by the tax code. Another client had a fine art collection that was significant, appraised at approximately $6 million. She needed $2 million for a business opportunity and didn't want to have to sell the art. We connected her with a specialized lender. She borrowed against two specific pieces of art. The art stayed on the walls. The investment closed on time. Two important notes here. Aviation, deductions, and depreciation require documented, genuine business use, and the IRS scrutinizes these heavily. Work with a tax counsel that knows what they're doing. Art lending's a little bit less regulated of a market. You definitely want a specialized lender, though, that understands how to appraise. Box spread loans. This is one that most financial advisors don't know exists. A client needed $3 million in short-term liquidity while waiting on a private equity distribution. They had a large taxable brokerage account with significant embedded gains. Selling was not a great option. Their options trading authorization was already in place on the account. They worked with their tax counsel and their advisor to structure a box spread loan using broad index options. That generated $3 million in liquidity at a rate meaningfully below prime. The distribution came 4 months later, the position was closed, and the all-in borrowing cost was significantly lower than a traditional securities-backed loan would have cost. This requires genuine options trading capability and experience. If you're going to do it, you want to do it with a team that knows what they're doing. These have to be executed in the right way. If the structure is off, it can expose you to a lot of risk. These are not appropriate for every investor. Intra-family loan. A founder in her early 50s who had just had a significant exit from a business wanted to help her son purchase his first home without depleting her lifetime gift tax exemption. A $500,000 outright gift would have used a meaningful chunk of it. Instead, she structured a midterm intra-family loan at the IRS applicable federal rate, way below what any bank would have offered. As of May 2026, that rate for a midterm loan was 4.08%. She had to have a documented promissory note and a real repayment schedule to make it legit. The son got the capital he needed at a rate he couldn't touch commercially. The mother preserved her exemption. The whole thing was in place in under 2 weeks. The economics and the benefits stayed within the family. The IRS scrutinizes intra-family loans closely. Make sure it's a real loan. Document it, have an actual repayment schedule, or else they'll treat it as a gift. Premium financing for life insurance. A married couple, both in their early 60s, significant estate tax exposure, way over $50 million net worth today. Their estate plan calls for a large second-to-die life insurance policy inside an irrevocable life insurance trust to help pay estate taxes at death. They needed to fund $400,000 in annual premiums into the policy. Doing that out of pocket would have meant diverting significant capital from a well-performing investment portfolio. Instead, they coordinated a premium financing arrangement through a specialty lender, using the cash value in the policy as collateral. Their out-of-pocket in year one was roughly $60,000 in interest, not $400,000 in premiums. The projected death benefit is $18 million, income tax-free to the next generation. It's the same outcome that would have happened had they paid the premium at a fraction of the capital required. Big note here. If the policy underperforms projections, the interest costs can exceed the internal growth, creating an out-of-pocket liability. This is one of the most complex financial and lending structures out there. Make sure you're working with a specialized estate attorney, insurance advisor, tax counsel to make sure this works in the right way. Graegin loan. This one is for a very specific situation, but when it applies, it can be one of the most powerful estate planning tools available. A Graegin loan is used where an estate is asset rich, but cash poor to help with the estate tax bill owed without having to sell the asset. A business owner passed away unexpectedly. His estate was worth north of $25 million, primarily an operating business and commercial real estate. Big estate tax liability and very little liquid capital to cover it. His family came to their advisor in the middle of the estate settlement. They worked with an estate attorney and a specialized lender to structure a Graegin loan, borrowing against the business assets and commercial real estate to fund the estate tax payment. Critically, the full interest on the loan was deducted up front as an estate administrative expense under a specialized part of the tax code. The family avoided forced sale of the business and the real estate, and the IRS got their money on their timeline. The loan's got to be bona fide, proper terms, genuine necessity, real repayment structure. The IRS will scrutinize this arrangement. Make sure to work, again, with a lender that knows what they're doing, an estate advisor, and tax counsel. The 1042 loan is part of an ESOP sale with tax deferral. If you own a C corporation and you're thinking about an exit, this strategy can defer and potentially eliminate the capital gains tax on your sale. Here's the concept. A business owner sells their shares to an employee stock ownership plan, an ESOP. Under Section 1042 of the tax code, if the proceeds are reinvested into qualified replacement property, the capital gains tax can be deferred. If the owner holds that property until their death, they can get a step up in basis to market value, effectively eliminating the tax completely. Big note here. The IRS scrutinizes these transactions very closely. Make sure you work with an ESOP specialist, specialized tax counsel, legal counsel to make sure this works in the right way for you. Nonprofit and foundation lending. Most people assume nonprofits and private foundations can't or shouldn't borrow money. The reality is that strategic borrowing can be one of the most powerful tools available to these mission-driven organizations and to the families who fund them. We have an individual who runs a private family foundation with a $12 million endowment. They identified a once-in-a-decade opportunity to acquire a building that would serve as a permanent home for their mission. But the timing didn't align with their grant cycle, and liquidating endowment investments at that moment would have meant selling at an inopportune time with the stock market where it was at. So they structured a short-term foundation loan secured by the endowment, funded the acquisition of the property on their quick timeline, and then repaid the loan 14 months later when their investment portfolio in the endowment had recovered and grants had been received. The building is now owned outright, the endowment's intact, and the mission now has a permanent home. Pretty cool. Lenders require special evidence of reliable revenue streams or strong collateral on these loans. Interest costs and repayment obligations may need to be carefully assessed here. We don't want to overborrow when we're managing an endowment or a foundation. The combination play. Here's the thing about everything we just covered. Most families don't use just one tool. They use two or three, layered together around specific goals. Let's take a founder who just sold his business. He needed to fund the $12 million purchase of a property. He now needs to do a big life insurance policy for estate taxes, and he wants to help his adult son get into his first home. So we're going to use three tools here. First, specialized jumbo mortgage and a securities-backed line of credit. Use the securities-backed line of credit for the down payment. Use the jumbo mortgage to buy the home. Finance the property. $0 having to come out of portfolios. Everything stays invested. No taxes triggered. Premium financing. We've got an irrevocable life insurance trust. There's a $20 million life insurance policy in it. We're just paying the interest. The premium financing arrangement pays the big premium. Intra-family loan. We got capital to the son to buy the home that he wanted. We got a loan set up for him at the applicable federal rate, way below normal market rates. Three problems, three tools, zero assets liquidated, zero taxable events triggered. That's what strategic lending looks like. Not borrowing money just because we can or we feel like we have to. Borrowing because it's the smartest, most strategic way to come up with capital. Powerful tools built within the framework of what's the collateral, what's the timeline, what's our risk tolerance. Remember, the right answer is almost never one tool in isolation. It's the combo play, engineered around your specific situation, the collateral, and the goals. None of these you walk into a bank and ask for off the shelf. Most require specialized relationships, minimum asset thresholds, and planning that spans your lender, your tax counsel, your attorney, your investment advisor. Our focus is on families navigating significant liquidity events, business sales, and the complexity that surrounds these things. If that's where you are or where you're headed, the link below gets you on our calendar for an intro. Again, no pitch, just a conversation about what's possible for you and your family. Thanks for watching. Subscribe for more, and I'll see you on the next one.